Well, good morning and welcome to the Reserve Bank. And with me, I've got John McDermott, who's the bank's chief economist and assistant governor. And I hope the press gallery Christmas party went well last night. I'm sure it went long. So the Reserve Bank today reduced the official cash rate by 25 basis points to 2.5%. Globally, economic growth is below average and inflation is low, despite highly stimulatory monetary conditions. Financial markets remain focused on weaker growth in emerging economies and on the expected tightening of policy in the United States. Growth in the New Zealand economy softened over 2015 due mainly to lower terms of trade. A recovery in export prices, the recent lift in confidence, and growing demand from the rising population should see growth strengthen over the coming year. The rise in the exchange rate since August has been unhelpful, and further depreciation would be appropriate in order to support growth. House price inflation in Auckland remains high, posing a financial stability risk, but there are some early signs that it may be moderating. CPI inflation is below the 1 to 3% target range, mainly due to the earlier strength in the New Zealand dollar and the 65% fall in world oil prices. The inflation rate is expected to move inside the target range from early 2016. There are many uncertainties and risks to this outlook. Dairy prices could remain weak for longer, and the current El Niño could deteriorate. On the other hand, net migration could stay high for longer, with household spending picking up on the back of strong house prices. Monetary policy needs to be accommodative to help ensure that future average inflation settles near the middle of the target range. We expect to achieve this at current interest rate settings, although we will reduce rates if circumstances warrant. We will continue to watch closely the emerging flow of economic data. So thanks very much. Happy to take questions.
Governor. Oh, sorry.
Rob.
Just looking at some of the underlying data you've got here and also the record the last 3 years, would it be a heck of a lot easier for you if you just targeted core inflation?
Well, there is a difference. It's a very good question. I mean, there's a difference between headline inflation, which is currently running at 0.4% on an annual basis, and that's largely because of the decline in oil prices, and core inflation, which is running at 1.5%. Most central banks, and there are about 30 central banks that do flexible inflation targeting. Most of them target headline inflation over a medium-term concept, on a medium-term context, but they also look very closely at what's happening to core inflation or underlying inflation. Headline inflation is basically what affects people's purchasing power. It's an index that they're more comfortable with, they understand better than core inflation. But let me see what John thinks.
Yes, it is an interesting question. Core inflation is the part of inflation that's more closely associated with the key economic drivers, and that's what matters. And if you're thinking about the very long run, I mean, the target is about getting future inflation, back to target. And by the time you're 2 or 3 years out, our view of core inflation and headline inflation is actually the same. But in the near term, when there's all these temporary features, throwing headline number around, it just creates some confusion.
I actually had a similar question. I'm wondering whether you feel that the PTA's focus on the midpoint of the target range is a bit detrimental, particularly in these sorts of circumstances when you've got these financial stability risks with the property market and so forth.
Well, we we think mainly in terms of the bands, the 1 to 3% band. And why we went to a midpoint concept, as many central banks have, was because in recent years, if you look back, inflation expectations seemed to be around 2.5%, and we were consistently towards the top end of the band, more closer towards the 3% than the 2%. And so we really wanted to try and get inflation expectations down by saying over the medium term, and we emphasise the medium term here, we really wanted to try and get inflation within the 1 to 3% band, but try over time to move it towards 2%, the midpoint. And that's what our forecasts show. I mean, compared to the September MPS, we basically said we think on the basis of the assumptions that are in these forecasts that we'll get to that midpoint probably about a year later, so towards the end of 2017. You always face a judgment about, do you want to bring that forward? If you wanted to bring it forward, then clearly you would cut interest rates more aggressively, but that would increase the housing risks. But let me see if John wanted to add anything.
No, I think we'll leave it there.
Okay.
But just quickly, I mean, do you feel that is this still an appropriate target for you, given that globally central banks are facing this issue of having to, facing very, very low inflation rates despite record monetary stimulus?
Yeah, I mean, it's interesting that global output is roughly running at about 3% at the moment. And that's the lowest since 2009, despite really unprecedented monetary accommodation. So inflation's been lower than pretty well what every central bank expected. But none of them have moved away from inflation targeting or flexible inflation targeting. None that I'm aware of have changed their inflation targets. I mean, what's happening is that it's proving difficult to raise inflation at times when you've got excess capacity in the economy and you've got high levels of household debt. The interesting situation in our case is that we have inflation expectations. We measure it with 7 indicators, but if you average those indicators, we've got inflation expectations around 2%, and that's really where we want them.
Yeah, just wondering, for the average borrower punter out there, if you could just explain the core reason for cutting rates today. Is it literally just to get inflation up?
I think it's certainly linked to the level of inflation and in the economy and the PTA, and in that context, it certainly is linked to that. But in essence, we've got inflation pressures that are pretty muted in the economy. We've got the exchange rate since the September MPS has appreciated by 6% on a TWI basis. If you look at oil prices, be it Brent crude or WTI, they're down about 6% since September. We've seen volatility in dairy prices. I mean, the last auction was positive to take whole milk powder prices up to, $22.60 a metric tonne, US dollars. But you're seeing still a lot of uncertainty around the commodity price outlook. We've got risks and uncertainties that we've talked about in the monetary policy statement, things like the El Niño risk, for example. Commodity price adjustments if dairy prices don't continue to pick up. There are risks around China and global growth. So it's a combination of things. It's a combination of the sort of risks that face the economy, plus also the fact that inflation is low and we've seen some relative price changes.
Again, for New Zealanders, why do they want prices to go up? I mean, there's nothing magic about
an inflation target of 2% over the medium term, or 1.5%, or whatever. But there are issues around dangers of having low inflation. There's risks essentially that if you have low inflation, that you get adverse shocks that could put you into deflation in terms of negative inflation. You can also have concerns that there are issues there of fairness as well, in essence. The fact that interest rates are very low does affect the returns to savers, for example, those that are dependent upon retirement incomes for their future is thus certainly affected. But there's nothing magic about saying that 2% is better than 1.75% or 1.5%. But there are some dangers in having inflation get to very low levels. But John, did you want to add anything?
It's an interesting question you pose. Certainly at the moment, cost of living is pretty stable, and there's probably people like that. That is a good thing. But keeping it here does keep the whole economy vulnerable to an adverse shock. And again, you wouldn't want to increase the risk of getting into a Japanese-style situation where prices continue to decline, and that stop people actually buying goods and services and further spiral the economy into actually not growing. So you want some zone of comfort.
The other side of that equation, there has to be wages, right? So would you expect to see strong wage growth as well if you're going to get inflation up?
Well, we've actually seen real incomes rise reasonably significantly in the last couple of years or so. That's mainly because inflation has been so low. If you look at the labour cost index and compare that with, or if you look at nominal wage outcomes over the last 2 to 3 years, and you measure actual inflation, CPI inflation, you've seen some real increase in wages. And that combined with the very strong employment growth, because you've seen roughly, until the latest number came out, you'd seen something like 6% employment growth over the previous 2 years. So you'd seen quite an increase in household income.
Isn't there a problem here when you've got very low interest rates and there's no encouragement for investors, and they say the best investment is housing? So you, of course, rekindle the housing market, particularly in Auckland.
Yeah, there's certainly interest rates affect the cost of borrowing and the demand for housing. What's driving Auckland, the Auckland housing market, I think, is several things. I think the immigration inflows have been a huge factor there. If you look at net permanent long-term migration of working age population, it's roughly running at 55,000 at this point. So that's a 1.5% increase in the working age population. Now, over the last 3 years, that increase has been over 3%. Now, half of that, we think, is going into the Auckland market. So although you're seeing supply, housing supply in Auckland increase, so permits are now running at a 10-year high. They're up about 18% over last year. The amount of building that's taking place is probably not even matching the migration flows into Auckland, because we think roughly half the migration flows are going to Auckland. So that migration has been a huge factor in the Auckland market, plus the shortages that already existed there, the 15,000 to 25,000 houses. But certainly low interest rates are a factor as well. There's no question about that.
Next week we've got the US Federal Reserve's anticipated move. What sort of there's quite a bit of debate amongst economists over what effect that's going to have on the New Zealand exchange rate. Are you expecting a sizable effect, or not as much as perhaps we might have seen previously?
It's a great question. I wish I knew the answer. I think the Fed have done a very good job trying to move market expectations. I mean, it wasn't so long ago that the market was expecting that the Fed, by and large, wouldn't move to March or April. And I think a number of their speakers, such as Stan Fisher and Bill Dudley and Janet Yellen, have done a very good job changing expectations about when monetary policy tightening might take place. So I think there's a heavy expectation, something in excess of 75%, probability that the US will move in December. The impact on the exchange rate is very hard to sort of anticipate. I mean, the US dollar strengthened quite considerably over a period of time, but for the last 9 months on an effective basis, it's actually been flat against their major trading partners. So at this point, if you look at the Federal Reserve data, their effective real exchange rate comparisons, they would say they're 14% above the 1971 average, the average since 1971. So it remains to be seen just how the markets respond to a tightening of policy. A lot will depend, I think, on the statement that comes out, and particularly what it says about future tightening. I think a lot of people think that probably the US dollar will strengthen over time, but I think a lot of that depends on the statement.
Just coming back domestically. One of the things that's changed here over the last year has been the deleveraging, which happened since 2010, seems to have ended. Looking at the most recent figures, does that worry you? And has that affected or fed into your considerations for cutting rates today?
The household savings rate is fallen a bit. It's been recovering since the GFC in general, and it has fallen. And it's certainly adding strength to consumption as a result, and consumption's quite strong, partly because of the migration flows, partly because of the real income increases that I just talked about, and partly because of migration. At this point, we're not too concerned about the credit aggregates that we're seeing. We are still seeing, if you look at it in terms of net flows, we are still seeing quite a lot of people paying down their mortgages still, and that's been a significant factor. And they pay it down simply because, if you look at the potential earning yields on fixed income or other forms of savings, it's still attractive to pay off your mortgage.
Governor, how concerned are you about a persistently strong net immigration, and do you want any policy changes in regards to this?
On net migration, policy changes, no. The net migration's been strong, and it's been strong for two reasons, and that's because fewer New Zealanders are leaving, and that process seems to have bottomed out, at least in terms of recent trends. We can model that pretty well by looking at basically Australian labour market indicators. Gives us a reasonable link with departures from New Zealand in terms of relationships. What we can't model well is the inflows, and the inflows come from many sources. They come from students, in particular from India and China. They come from people on single work permits, and they come from returning New Zealanders, often from Australia. So the flow has been much greater than what we thought. I mean, if you look over the last 3 years, it's been roughly around 110,000, or just over 3% of the labour force. and that's been a huge stimulus to the economy. The tricky issue as forecasters is whether the demand side effects come through more quickly than the supply side effects. So the demand side effects will come through in terms of housing demand, it'll come through in terms of consumer spending. The supply side effects come through the fact that the labour force has now increased and the country has, or the economy has more capacity to be able to absorb demand side pressures. So the tricky thing in the migration numbers, which in general are a good thing, I think, for New Zealand, is whether the demand and supply side effects, which comes through, which dominates in the short to medium term. Did you want to add anything, John?
No, I think there's quite a lot there.
Yeah, I'm sorry, it's a long answer.
Hi, Glenn Stevens has said that the ability to use interest rates to affect, spark growth and demand has decreased since a decade ago because there is less desire from households to borrow and spend. Do you share his concerns?
Yeah, I think, monetary policy decisions are always tricky, partly because pretty well everyone in the country seems to have a view about whether monetary policy is right or wrong. But what I think central banks have found is that it's been very hard to move inflation expectations upwards once they become unstable and start declining. It's been very hard to move those inflation expectations upwards, particularly in an economy that has high levels of household debt and consumers or borrowers are reluctant to take on more debt. And that makes the job, in essence, of monetary policy much harder. Did you want to add anything, John?
I might add one point. This week we've had experts from around the world visiting the bank, and we're having a conference about how our frameworks actually operate. And one of the key things lots of central banks have learned is actually monetary policy is actually quite hard. It takes a lot longer than you think. Actually, even when you know that, so start thinking about that. Monetary policy often has to stay restrictive longer than previously planned when the economy is booming. And on the other side of it, often we're learning that there's a sort of a asymmetry where you have to remain accommodative a lot longer than you previously thought. So in fact, the lags in monetary policy seem to have lengthened. And I think that's what Glenn was referring to in part, that actually the elasticity between monetary policy and the ultimate goal is a lot lower than we previously assumed.
I think what Glenn also worries about is that the cost of capital has come down for firms. As interest rates have come down, the cost of capital for them has come down. But he feels they haven't adjusted their expectations about target rates of return. So one of the big issues in Australia is while the CapEx has been coming off in the mineral sector, which has been expected, business investment in other sectors hasn't been increasing. And that's been an issue in the US, it's an issue in the UK, it's an issue in Australia. And Glenn argues that, well, if the cost of capital's come down, why haven't trigger rates of return come down before entrepreneurs will invest?
Given the difficulties you have in getting prices up, inflation up, would it be helpful if the government was to loosen the purse strings and spend some more money?
It's interesting. One of the reasons why inflation's low, you get a whole lot of factors that cause inflation to be low. I mean, oil prices is one of them. But also, for example, licensing fees, motor vehicle licensing fees have taken 0.3 off the inflation rate, for example. A lot of the focus tends to be on monetary policy to basically work out price output splits for an economy, if you like, to try and get some demand growth and output growth and also maintain low inflation. And one of the issues is, what role can fiscal policy play? I think one could mount a case for saying, look, there's the potential to have more infrastructure spending, for example, around Auckland. I mean, this is an economy of roughly 230 billion. So some CapEx expenditure by the government could well be helpful to try and reduce excess capacity in the economy and reduce, from our point of view, reduce the output gap and build inflation pressures would also be something that would be helpful.
On that, what about their operational spending, and what if they were, for example, to have a more flexible set of fiscal policy targets than they have had for the last 4 years? Would that be helpful for the bank?
Well, I think I'd make probably the general point rather than talk about the specifics of the last 4 years. You know, there's many reasons why governments have fiscal targets, be they debt targets as a share of GDP or deficit or as a share of GDP or moving towards surplus. And they put a lot of credibility in trying to achieve those targets. But I think the general point I'd make is that, you know, one shouldn't be, as a policy maker, I think, you know, don't just always look to monetary policy to affect levels of demand in the economy. Fiscal policy can also play a role. And there, I think arguably is a case for more infrastructure-related spending around Auckland.
Governor, do you think you could have cut more or lowered the forecasts for the 90-day bill rate if you didn't have concerns about financial stability related to the Auckland housing market?
Well, we certainly think a lot about the housing risks. But, you know, the judgment we've made is that, in essence, with all the uncertainties and risks around forecasting that we've talked about in the monetary policy statement, I mean, our central expectation is that we think that the current interest rate settings will move us back to our inflation objective over the medium term. And if we're wrong about that and situations evolve, you get new information all the time, then if that proves to be the case and we need to cut rates, then we will do so.
You mentioned in your October speech that you wanted to perhaps keep a bit of powder dry and that rate cuts may not necessarily boost the economy much. Was that a factor in your thinking today? Are you trying to keep some powder dry?
Well, I think it's something that central bankers, I think, are always conscious of. Some of them are in a pretty difficult situation now, like the ECB, which has deposit rates at minus 0.3%. We've got interest rates at 2.5%, which compared to the US and Europe, I think is still a buffer. There's room to cut if we need to, and that's what we've indicated in our statement. Did you want to add anything, John?
Oh, I mean, on that point, I think it's worth emphasising, of course, we think we've done enough so that we will achieve the mandate. And that's important too. But you also have to remember that very, very, very low interest rates kept there for a long time also increase the risk within the economy. And you have to be conscious of that. How you do the calibration is always tricky. So.
Yeah, I noticed that your TWI forecasts are now just a little bit higher than they were in the September MPS. So I was just curious because you have said in the statement that a lower dollar would be good. But is the New Zealand dollar at the level it is now fairly consistent with rates staying on hold?
Do you want to cover that, John?
Yeah, I mean, putting the TWI track in a statement is always one of those difficult things. And we actually often don't refer to it as a forecast. It really is one of those very technical assumptions. You take it where it is today, you look at interest rates around the world, you do the calculation, and it sort of mean reverts back to some long-run level. And that's a starting point. And then from that, you work out what are the inflation consequences and where that moves. Because the reality is, in terms of trying to forecast the exchange rate, markets can do all kinds of strange things between now and 6 weeks, let alone the 3-year horizon we have to forecast across. So bear in mind that's the feature of the exchange rate that we've got in here. And that's why it's very important we come back every 6 weeks to update the situation, see where we are on that front.
But are you fairly comfortable with the level that it's at now?
Actually, one of the things we're looking at is what the impact it's having on our exporters, and it's something we always worry about. And if you take a broad measure, you look at what other people have said about the exchange rate, it does look to be higher than is necessary to stabilise this economy. It looks higher than it would be from a debt point of view. So I don't think we'd say we were very comfortable at this level.
If you look at projections about net external debt as a share of GDP, and you say, what's the exchange rate, that over time you think you can stabilise those projections, then our analysis suggests that the exchange rate should be lower.
There's been a lot of debate, Governor, about whether new technology is improving productivity and potentially lowering structural inflation globally and here. What's the bank's view on whether this technology could actually allow the economy to grow faster with low inflation and therefore with lower interest rates?
Well, I might ask the former government statistician his views on that. I mean, if you look at non-tradables inflation, that's been the interesting thing. Why has that been lower than what we thought? And part of the answer to that has been the fact that migration pressures have been greater, migration flows have been greater, so that the labour supply has increased and enhanced the capacity of the economy to be able to absorb the demand side of demand side pressures. So another way to think about it is that over the last 2 years or so, the labour supply has increased by 6%, but the employment has increased by 6.75%. Now, without that large increase in the labour supply, largely through migration and higher participation rates, we would have seen higher wage inflation. I think that's clear. So non-tradables inflation has been low, partly because of the strong migration pressures and the effect that's had on wage moderation. But I think some of it's also been due to just globalisation, technology. I mean, if you look at the costs of technology, of storing, transmitting information, the marginal cost is zero. It's been zero for a long time. Globalisation of services and goods sector, I think that's been part of the equation. I think the fact that more goods, and particularly in the States, less so here, but the fact that consumers buy more goods on the internet has probably put pressure on retail margins and things. So there's a lot of factors involved, I think, some of which we understand well and others that we've got to learn more about. But let me ask Jeff and see if John also has some thoughts.
Thank you. I'll just add that technology change is the essence of a lot of productivity growth, and there's certainly been evidence in New Zealand that computer-related, IT-related investment has been a big part of the productivity growth that we've had. And, that is a source of keeping, as the Governor has said, cost growth down. Productivity is the other side of that. It keeps non-tradables inflation low. Whether it's dramatically different in recent times from what it's been for the last 10, 20 years, I think it's more debatable. It's a source of a long-standing growth and improved performance, and long may it continue. That's where real incomes come from.
Did you want to add anything, John? Okay.
Governor, just on the risks, the 4 risks that you've cited in the MPS, what are the probabilities that you've got attached to those occurring, and out of them, sort of, what's the one that's causing you guys the biggest headache?
We didn't attach probabilities to them. But I'd say the biggest risks, and my colleagues may have different perspectives on some of this, but I'd say the biggest risks are around China and global growth. The fact that, as I say, global growth's at its lowest since 2009, despite extraordinary monetary policy accommodation. Having said that, I think the perspectives on China have become more optimistic in the last 3 months, certainly since we got through the August equity market adjustment and some pretty unusual policy responses by the Chinese authorities. I'd say the El Nino, and there the risk is how long it goes for and where does it hit. So, for example, if it went through the summer months and into autumn, for example, and it affected the Waikato region and possibly Taranaki, then that could have significant effects. And so we spent quite a bit of time looking at the 97 El Nino impact, which we thought was around 0.75% of GDP in terms of lost output. But things are a lot different since 97. I mean, you've seen enormous amounts of irrigation put in Canterbury, and Canterbury is where the biggest increase in the dairy stock has occurred. So if Waikato and other regions got hit, then that could be a factor. I think the other risk is immigration is stronger for longer. I mean, we've seen something like roughly 110,000 increase in net permanent long-term migration of working age people. Our forecasts build in about another 120,000 over the next 3 years, which is a record amount for New Zealand. That's a huge cycle. Whether there's upside on those numbers, that would be a risk as well. But let's see what John thinks.
Yeah, I mean, we purposely didn't put a set of probabilities around the scenarios because I think that's an impossible task. The thing you have to think about is what's the likelihood of those events taking place, and actually what are the impacts? You know, how strong are they, and how do they transmit through the economy? So there's a lot of uncertainties through that. And actually the other feature that's important is some of these risks that we're worrying about have a strong supply side nature, which makes them harder to evaluate. They often are much more persistent and have very different effects than history would otherwise suggest. So there's a lot of those things to worry about. And the last point I would make is just to emphasise how we're going through this and we're taking this very seriously. It is unusual to talk about 4 risks in a single statement, and you have to go back many years before we'd highlight so many risks that we're being confronted with.
Governor, NZIER have proposed a change from inflation targeting to nominal GDP targeting. What's your view on that?
I was at a BIS meeting probably about 2 years ago, and the paper that was being discussed was looking at different monetary policy frameworks. And so there was a discussion on nominal income targeting, and I guess there were about 30 governors in the room, and not one of them supported nominal income targeting. I don't think any central bank in the world has adopted nominal income targeting. It essentially involves targeting a path for nominal income growth. And essentially you would be indifferent between the price output split on that nominal income path, on that nominal GDP path. So for example, if you had a supply side shock that increased output, right, you would need to try and offset that through your monetary policy in terms of a reduction in inflation. Now, some of that might happen anyway if it's a positive productivity shock. But in essence, you've got to offset whatever happens on the output side with an inflation adjustment. And that leaves quite a lot of uncertainty about what your inflation objectives are in an economy. And I think some economists would argue that if that's greater uncertainty people have about the inflation path, then you'll see term risk premia increase. So that's another issue. The other one, of course, is GDP revisions happen all the time. The CPI doesn't get revised. Oh, let me make sure I'm right on that, Jeff. It's extremely rarely. Extremely rarely. There we go. Correct myself. Well, thanks very much indeed.